Don't wait until January. Make sure you do these things before December 31st. Hey guys, it's Adrian here, the Canadian in a t-shirt. And here are the must-do steps before the new year to lower your taxes and save you money. If you wait until January, it will be too late. This is the 2024 edition. Normally, I don't like remaking older videos. It'd be great if it came back every year like a Mariah Carey Christmas song, but for all of you new to my channel, this information is very important and we only have a week left. So I decided to make a new video with some updates. I'll go through the steps in order of priority. Feel free to skip ahead. Starting with the FHSA, the First Home Savings Account. It's meant to help Canadians buy their first home, and it combines the best benefits of both the TFSA and the RRSP. All the money you put into the FHSA is tax deductible. It lowers your tax bill just like the RRSP, and that money is invested and eventually withdrawn tax-free like the TFSA. It's a game changer, and maxing it out will be my top priority every year. But this is important. Make sure you open your FHSA before December 31st, even if you don't put any money in. Let me explain. Unlike the other tax-free accounts, with the FHSA, you only start building contribution room once you actually open an account. Even if you don't have a lot of money to put in, make sure you open the account. At least you'll be gaining that $8,000 of contribution room this year and next. As long as you open an FHSA by December 31st, that $8,000 of unused room for 2024 will be carried forward. So on January 1st, 2025, you'll have a total room of $16,000. If you wait until January to open your account, you miss out. You'll only have half the room, $8,000. And if you max out, you'll have to wait a whole extra year. Don't make this mistake. You can keep the FHSA account open for up to 15 years. Buying a house might not be on your radar, but 15 years is a long time. So get started and open this account before December 31st. And don't worry, you don't have to max it out with $8,000. Contribute what you can. Whatever you put in will give you flexibility with your taxes. If you contribute $1,000 before January, now you get a choice. You can claim that tax deduction right away and lower your tax bill for 2024. Or you can carry it forward to next year and get a bigger tax refund if you expect your income to grow. You can carry forward this FHSA deduction the exact same way as an RRSP deduction. I have a whole video breaking this down. Now, this rule is important and it can be confusing. With the FHSA, only $8,000 of unused room can be carried forward. What that means is you can't stockpile contribution room like the TFSA. With the TFSA, your room accumulates every year no matter what. You can do nothing for 5 years and then dump 30 grand all at once. Not with the FHSA. Only 8,000 of unused room is carried forward. You never lose this room. You'll always have 40,000 to contribute in your lifetime, but you can't do it all at once. You can never contribute more than 16,000 into your FHSA in a single year. So the best approach is to be consistent. Try to contribute 8,000 every year or as much as you can. This gives your money more time to grow tax-free. But give yourself a head start and open your account before December 31st. Check out my FHSA explained videos for all the rules and how to open an account. I opened my FHSA with Questrade. Link down below to sign up with a bonus. Up next, we have the RESP, the Registered Education Savings Plan. This is a tax-sheltered account for your child's post-secondary education. Tuition is very expensive, and the RESP can be a huge help, especially with the free grant money from the government. Here's how it works. Whatever money you put into your child's RESP, the government will match 20% of that in grants, up to $500 every year. That's free money, so take it. Here's the strategy. Try your best to contribute $2,500 per child every year into the RESP. That way, you'll earn the maximum $500 of free money every year. Keep that up, and after 14 years, you'll reach the lifetime max of $7,200 of grants. Don't miss out on this free money, so it's important to make this $2,500 contribution by December 31st. If you miss a year or can't contribute the full $2,500, that's okay. You can catch up on these grants, but only 1 year at a time. Meaning, if you have unused grant money, you can double up. Put in $5,000 into the RESP and collect up to $1,000 in grants. But this should only be used as a backup plan if you miss a year. The best approach is to put in $2,500 per child every single year and do it before December 31st. Don't wait until January. You'll miss out on that $500 and you might not get it back. There are a lot more rules to cover. Watch my 2 RESP explained videos, link down below. Next we have the TFSA, the tax-free savings account. This is the most flexible account. There aren't any deadlines for contributions. If you don't max out your TFSA, that unused room gets carried forward, so it doesn't really matter when you contribute, in December or January. What does matter is when you withdraw from your TFSA. That timing is very important. If you need the money and you know you're going to withdraw from your TFSA, please do it before December 31st. Here's why. When you withdraw from your TFSA, you can't put that money back for the rest of the year. But whatever amount you withdraw, you regain that contribution room on January 1st. Let's say I'm maxed out and I need to withdraw $2,000. For the rest of the year, my TFSA is still maxed out. I can't put in a single dollar until January. If I withdraw in December, I only have to wait a few weeks, and then on January 1st, I regain that $2,000 of room plus the $7,000 of new room that everyone gets for the new year. Instead, if I wait until January to withdraw that money, I'll need to wait an extra 12 months until next year to regain that contribution room. Here's the bottom line. December is the best time to withdraw from your TFSA. January is the worst. So if you need to withdraw, do it before December 31st. The RRSP, the Registered Retirement Savings Plan, has a different schedule. It doesn't follow the calendar year, January to December. Instead, the RRSP calendar starts on March 3rd. This means that any RRSP contributions in the first 60 days of the new year count towards your previous year. That's a good thing. This way, we gain an extra 2 months to run the numbers and make a plan to lower our tax bill. If you had a high income in 2024, you can contribute to your RSP by March 3rd, and that deduction will lower your tax bill. So you'll receive a tax refund when you file your tax return in April. Just like the FHSA, you don't have to claim that tax deduction right away. If you'll be in a higher tax bracket next year, you can carry forward that tax deduction and get a bigger tax refund. Watch my RRSP guide for more great tips. So for the RRSP, there's no rush for December. The RRSP deadline is March 3rd, 2025. For all of these deadlines, don't wait until the last day. Contributions and withdrawals can take a few business days to process, so plan ahead for that. To invest in your TFSA or RSP, you'll need a brokerage. I love Questrade and Wealthsimple. Links down below to sign up. But here's a new platform that I'm using called Moomoo. They have some of the lowest fees out there, especially for US stocks. I'm not kidding. With Moomoo, I'll be saving thousands on conversion fees. Watch this video for my full review and use my referral link down below to get a $300 sign-up bonus when you deposit $5,000 or more. And if you transfer from your bank or brokerage, you get an extra bonus. Transfer $10K into Moomoo and you'll get $500. That's free money, so take it and invest it. Make sure you watch my year-end tax saving tips. It's a longer video full of important strategies that I use every year in December. I break down tax loss harvesting, the superficial loss rule, transferring between tax sheltered accounts, and more. This will be my last video for 2024. So thanks everyone, and I'll see you guys next year on the Canadian in a T-shirt. Bye guys.